Hey everyone, it's Nick with Us versus Her. Today I want to talk about shorting stocks on Robinhood and betting against the market on Robinhood. I know a lot of the people that are subscribed to this channel, they're using Robinhood to trade. You know, if you're using other brokerages, that's great too, but a lot of people are using Robinhood right now. So I just want to kind of cover this real quick on how you can bet on the market going down or make money on the market going down. Basically, a Robinhood, as you can see here, says they don't support short selling. If you don't know what short selling is basically you're borrowing shares. So someone's loaning you those shares that hopefully you can buy back at a lower price. So you make the difference. Now, however, if it goes against you, if you short the stock and it goes up, then you got to pay. You got to pay the difference on that one. So they're saying they don't support short selling mainly because they know a lot of the people that are on their platform don't really know how this works and they're protecting themselves. Also, they recently did with Robinhood Gold have margin accounts. I mean, you need to have at least $2,000 in your account, and then you have you can get a margin account, but you got to pay them like $10 a month. So with that being said, now that Robinhood allows options trading, I'll give you two different ways that you can short the stock using options. So we'll just go over to Robinhood right here, and we'll minimize this so it's not as distracting. I'm going to use Apple as an example to trade today. Market was down a little bit today, so if you were betting or trading stocks in hopes that they went down, a lot of the stocks went down today. I think most of my losses today were on Twitter. And Twitter was down 3%. I've been holding some stock here, but I'm still up. I'm up 126% on it. So we lost 3% today. But anyway, so if you were shorting Twitter, you would have made money today. But if you were long it, not making money. So let's go to Apple right here. And right now I choose Apple because it's pretty liquid. What you can do about trading Apple here is in Robinhood in the options, it does say, if you want to they have a discover page here. If you're looking for it to go up, you buy a call. If you're looking for it to go down, you buy a put. Pretty simple stuff. But what people don't realize is that you can also put on some spreads to also help you short the stock as well. Right here are the expirations, and then they also have here on this nice little splash page here some ideas for you to trade. I don't necessarily ever really take what they offer, mainly because they're basically what Robinhood is doing here, especially with options, and they know a lot of the people that are trading on here don't know how to trade. That's why they're offering these up right here. But the easiest way is, let's say I just picked one of the expirations up here. Let's say I just picked July 20th, which is this Friday. If you think that the market's going to go down, you buy a put. If you think the market's going to go up, you buy a call. But in this case, we'll go to buying a put. And as you can see here, there's a whole lot of pricing. It does get a little confusing. Mainly, especially if it's your first time in here, you're like, why are these more expensive than these, and what's going on here? And you can see here the share price is $190.27. These are more expensive up above because those are considered in the money. If you're buying options, you want it to go in the money. If you're selling options, or you're option seller or premium seller, you want them to stay out of the money so that way the options expire worthless. Options do have an expiration date, as you can see here, and if they are not in the money, or deep in the money, or around the money, but on the Friday of this expiration, so they expire every Friday, as you can see here, they're going to be worthless. So if even if it's even 27 cents away, so let's say on Friday at expiration, this is probably gonna be worth a penny or zero cents, depending on what the stock is doing. But the easiest way is to buy a put if you think the stock is going to go down. However, with buying options, you have to be careful because you have to make sure that it's going to be you're going to be in the money at expiration or before that. So the easiest way that I like to do it is, especially when I'm buying premium, I want to give myself enough time. So maybe I'll go out to, it's July right now, so maybe I'll go out to the September, give you 60 to 90 days, or maybe even October. But as you can see, these are a lot more expensive. And you're like, well, it's only $7 or it's only $9.95, but this is times 100 because one contract equals 100 shares. So this is not $9.95. This is $9.95 times 100. So if you go to, I think, the order screen here, you'll see here, contracts times 100 shares. This is going to cost you, if I put in one share here, it's going to cost me $995. So the nice thing about options is you'll make more money quicker instead of just shorting like on E-Trade or whatever. If you short one share and it goes down, or 10 shares, it goes down $1, you make $10. Here, if it goes down $1, you make $100. So for every dollar it moves, you make $100 as long as it's in the money. When it's out of the money, things get a little crazy because there's theta, there's implied volatility, and things get a little crazy. So what you want to do if you just want to short the market, short the stock, is just get one put. Now the other thing is you could do a short call spread. Now, like I said before, when you're buying a call, you want the stock to go up. But when you're short the call, so you can be short these just like stock. You could be short the premium. So all this premium here you can be short. So what you want to do here, you can sell them naked, but a lot of people don't have the money to sell that. So selling that would mean if I hit sell here, I click on sell, and I have the call highlighted. And if I clicked on, let's say, the 195 here, it's at 583. I would get $583 credit, but it's saying I would need to. Saying I don't have enough shares because it would cost me. I have to have another brokerage here. I think I could show you later, but it would probably cost me to short this around $20,000 in buying power. And the reason why this is selling naked, you're doing it undefined risk. So there's the higher Apple goes, the more money that you lose. But what you can do is you can define your risk by doing a vertical call spread. And what you want to do here is you want to short the one that's closest to the money and then buy the one that's out of the money. Or you would short the one closer to in the money. You could pick whatever strike that you want. It doesn't have to be in the money. It just has to be closer to in the money. So at 190.27, let's say I straddle the in the money and I buy the out of the money option right here. So what you do on the upper right hand corner, you hit select. Just make sure on sell, so that way you're shorting this. So I want to sell this 190 call here, and then I want to switch over to buy. So when I click over to buy, I'll be buying this option. Click on that one right there. And then as you can see at the bottom here, it says I have two options selected. And if I click on this, it'll say I'm doing a call credit spread. So when I'm doing a call credit spread, it means that I'm short. So I need this below the 190 strike by October 19th is this expiration. I'll be collecting $242, so $242 in credit. So my max profit is $242. And my max loss would be, so my max loss would be like $400 because I think I have about $200 in buying power right now. Yeah, I got $286. So they said I had to deposit some more money for that. I can pick maybe something lower price so you can see here. Let's just say AMD. We can do an options on this one right here. We'll go out to October as well. I'll sell the call. We'll sell the 15 call. That's 2020. We'll sell the 16 call here. So I did October, and then we'll buy the $17 call here. I don't want 3. We'll sell the 16 call. Let's do this again. Sell 16, and then you go to buy the 17 call. So saying I selected to sell this option, I'm selecting to buy this option. I have two options selected here. So it's $1 width here. I'll get $48 in credit, 48 cents. If I click review, I go to buy this, you'll see my collateral is $100 here. So my max loss is going to be $100. The amount of money that I can make here is $48. So you're on a call spread, you're defining the risk. So you're defining how much you can make. So it's not unlimited. When you buy a put or you buy a call, that's undefined. So you can make as much money, but you can also lose your entire investment. On this, it's saying I can only make $48, but I can also only lose $100 that they're going to take in buying power for me. So that's just a quick way. We can dive deeper into selling and buying options. There's other videos as well on shorting stock and shorting premium, and we have a lot of videos on this as well. If you have any questions, leave a comment below. That's just a quick and dirty way on how to short stocks on Robinhood now that they have options trading available.